So Josh, this week, despite progress on the domestic COVID curves, despite our economic index of surprises still very high, the market geared itself up towards momentum and some quarantine trades. So what was it? Was it a jobless miss or what?
Yeah, I think we got to focus on this week versus the bigger picture, and I'll start with the bigger picture and then come in back to this.
Okay.
Week. I think the big picture is we're still in the very early stages of an economic recovery. It's not even early stage; it's the very, very early stage. Whether it was May or June, we believe that the recession ended. Really only a matter of weeks or months ago, and we are continuing to see signs that the recovery is taking hold. We are continuing to see improving data. Housing starts this week came in just shy of 1.5 million. We were less than a million, not even 2 or 3 months ago. Mm-hmm. And the 1.5 million, this is the second or third best print of the last decade. So, taking a step back, that bigger picture view, the recovery's, just starting to gain steam, just starting to take hold. And the reason I start there is, you just mentioned jobless claims. And I think that your last two guests were both talking about maybe we're seeing a period of consolidation. I think that's happening in the economy as well. And in any early stage recovery, you're going to have unevenness. It's not going to be smooth sailing up into the right. You're going to have some choppiness. And jobless claims, I think, was that this week. We had a negative surprise. But this is not unexpected. It's going to happen. It's going to happen again. It happened a couple of weeks ago, maybe 5-6 weeks ago. We saw a little bit of a pause in the market, a little bit of pause in the economic data. The high frequency data like jobless claims, did stall back 5-6 weeks ago. And as we look forward, hopefully we'll see a period of consolidation for a week or two. Next week, we're going to new jobless claims number. We're going to get capital goods coming out. We're going to get consumer confidence. We're going to continue to get a series of really important real-time data that hopefully will move through this period of consolidation. But taking that bigger picture view, we continue to think the recovery is taking hold as we look at it.
So Josh, is there just a baseline flow into equities with so few options out there and possibly the Fed without incremental dovish moves? They basically said they're not looking at yield curve control yet. Negative interest rates way behind. And this week and last, gold has really stalled out. So that trade's not really working. The question I'm driving at here is the baseline that we kind of operate from, the tech and the NASDAQ strength and the overall idea that equities in the US as an asset class are going to be sucking up flows, and that the economic variance is what will determine whether other parts of the market do well. So basically you can have economic variance that doesn't hit the NASDAQ, and when we see from this week, we go, okay, depending on how the economy does, that'll determine if the rest of the market works. But as a baseline, should we just assume the NASDAQ works?
It's a great question. I think it's always a little bit dangerous to say, something's going to work forever. But it's absolutely.
Kind of seems like it.
It's absolutely what the market seems to be pricing in right now. No question, Oliver. When we've seen periods like this past week where some of these incoming data points are a little bit more shaky, we certainly revert back to more kind of tech and growth leadership. Whereas if we were here talking a week or two ago and we were getting a little bit more positive impulse from an economic front, we had a very brief cyclical value rally. And that's been kind of the story of the last several months. When it looks like we get that positive upswing in the economy, even if it only lasts for a couple of days in most cases, we do see a sort of broadening out in equity market leadership. As we move, taking a step back, bigger picture, baseline growth is challenging. We have demographic headwinds. We've had really weak productivity for a long time. I think that's part of the reason why the market's pricing that growth, that tech are going to kind of be the baseline. Again, it's really hard to project that forever, and I wish I had a crystal ball. I unfortunately don't. But as we look forward, what could change this? I think a really important thing is going to be economic stimulus. We're currently in the middle of a little bit of a political gridlock in D.C. There's clearly a need with something like 15 million Americans out of work on an ongoing basis. It's not new people losing their jobs, obviously, but roughly 15 million Americans don't have a job right now. There's clearly a need for something to be done. Hopefully our leaders can come to a deal, and leaders on both sides of the aisle do seem to be like they're inching towards one. Speaker Pelosi came out 2 or 3 days ago and said that she'd be willing to cut her demands. The chief of staff of the White House said that he thought that there was a path towards a bill. So hopefully we'll be moving in that direction as we head back to school for those people who are able to go back to school, but as we move past Labor Day for sure.
Josh, one of the graphics in your report is about fiscal stimulus during crises, and obviously ours is very front-loaded. Assuming we do get another dose, this is one of the big questions right now is compared to other crises, I mean, we're already way, way, way ahead in terms of fiscal stimulus. Now there's kind of this, dog versus tail conversation where the real effect on Americans hasn't been as bad as in the global financial crisis or the tech bubble exploding, because people still got money in their pockets. So then what does that mean on the other side? If we do another dose here, is there a risk of making this line go too far up too fast?
There certainly is. I don't think we're at that point yet. And the latest negotiations in D.C. don't seem to be, the dollar figures they're talking about are continuing to come down. And I don't think we're going to be there with this latest round. It's certainly a possibility further out. But I think our policymakers, as well as the Fed, deserve a lot of credit. We were facing an unprecedented situation. I use the U word. I apologize. I've been trying to cut down on that lately. But as you said, this was a historically bad situation, and it hasn't played out nearly as bad as it could have. Part of it is the graphic that you have up on the screen. We got fiscal stimulus into people's pockets, both at businesses with the PPP program, the $1,200 checks that went out, the expanded unemployment insurance benefits. We got money into people's pockets, and that really helped kind of bridge the gap. A lot of these programs, when they were designed back in March and April, the policymakers thought that things would be kind of back to normal by now, and that's why, as they're starting to expire, we're having the conversation about, should we extend the length of the bridge? We thought it was about this wide. It turns out it might be a little bit further, so maybe we need to extend the bridge. But I think the Fed also deserves a lot of credit. Financial conditions have really stabilized. Credit issuance is at record levels. Credit spreads are coming down. They're not at, kind of pre-coronavirus levels, but they're certainly at much more healthy levels than they were a couple of months ago. And policymakers have done a great job of